Welcome to StockOdds Odds and End podcast. I'm Dave Singh here with Rob Friesen, getting ready for the week ahead. Good evening, Rob. How's everything?
Not too bad. Thank you for making this happen every Sunday. I appreciate you. It's really good to kind of lay things out and take a tour of the week before the week starts, get our bearings, and I hope it does translate to providing some value and helping traders. That's our goal here. So
Good stuff.
I'll start with sector performance for this past week here. Now remember, we kind of came off the abrupt Thursday and Friday move last week, now which, as we showed you last week, on Friday, for example, all sectors were green robustly, as well as for the week, and that doesn't happen that often. But it was an interesting week nonetheless. It was a shortened week, right? So, but here we had a full week this week, and it looks like, for the Friday, technology and consumer cyclical bounced back. Consumer cyclical was strong for the whole week, whereas technology actually faltered a little bit. And why that came into play was because of the excess performance that happened the week previous. And as we came into this week, there was some pulling back of those mega caps and large caps that had benefited a lot from the AI thing and just from strong semiconductors and all that. So it was actually, we had a number of days this week where it was risk off, not risk on. So a little bit more broad market and like more defensive issues kind of came into play. But as the week finished, it rolled back towards the technology again. And that's been strong all year. And even for the month, tech is still up 9.79%. So even though you can see it down here slightly for the week, when you take for the month so far, it's been very robust. So moving on to the next slide here, you can see some of the breakdown. And again, when we look at these sectors here, those are more broader market sectors, whereas the ETFs here are the sector spider, which are only related to the S&P 500. So that's really the difference there. So there's more symbols in this one. So it's nice to look at both, look at the broad market and all that. So again, for the week, you had XLK performing slightly down, as well as XLP. Interesting there that XLP is consumer staples, XLK is technology. And, technology and communications are kind of in that category of what we're using for the risk on list. Basic materials can be introduced on the risk on list. It depends a little bit on what the US dollar performance has been. That might be brought into risk on. And financials can also be brought into risk on. It depends on, again, what the interest rates are doing. So if the bonds are moving down, rates are moving up. If the bonds are moving up, rates are moving down. So financials might come into play on the risk on list. And when I say risk on, I mean what the long exposure would be. So utilities could be in the risk off list, along with consumer staples and things like that. It depends a little bit on what the bonds are doing because of that bond element. Healthcare, you pretty much can keep it in the risk off category. Consumer discretionary, although both staples and discretionary have a bit of a mixed bag with some symbols. With XLY, we do treat that as risk on, and that performed pretty well for the week, as you can see. So a standout there. Anyway, it's good to look through this and see how they're doing, for the week, for the month, for the quarter, and think about that persistence of performance, but also where there might be mean reversion, where things might get, way ahead of itself. And certainly technology is getting long in the tooth, but we'll look at some seasonality here with Dave in a minute and see, are we done this run yet? We mentioned last podcast, that June can have some trends, and especially related to the Russell rebalance and stuff coming up. but it can be a trendy month in commodities and often in technology and things like that. So keep your seatbelt fastened, and we'll we'll get through the month, and hopefully on good note. Okay, well, let's move to the next slide here. So why don't you take comment on this, Dave?
Yeah, so mid-month seasonality starts on Tuesday, I believe. It's the 9th, 10th, what is it, through 14th business day, 9th through 13th, or 9th through 14th business days?
Well, yeah, our calendar is the 9th through 14th. I'm glad you brought that up because, different parties view things differently. Like with example with Bright Trading, we always looked at sort of the 9th and 10th business day as more weighted. And I still hold to that, even though we have the 9th through the 14th within this calendar. But again, it's personal preference. It's not a bad idea to start looking at it already on the 8th, 8th day of the month. And that's business day, not calendar day. So the actual 8th trading day of the month, start looking at it and see what the setup is before the 9th and 10th. So I think the 9th day is Tuesday, right? Which is the same day that we start some other economic things that you'll talk about.
Yeah. So during that mid-month seasonality, there are some sectors that are expected to do better than others. It's really a risk-on kind of theme when you look at the individuals. ARKK, we have some of the biotechs, XBI and IBB, QQQ, XLK, so the XLY. So these are a lot of the risk-on kind of ETFs. These are expected to do better. And some of the things that are weaker are gold, oil, XOP, XLE, GDX, also materials, XLB, and some financials as well, KRE, and XLF. So I think weighted as more of a risk-on kind of theme for mid-month seasonality, and a little bit weaker on oil and metals. And if you look at the entire, so the NASDAQ is expected to do 1.26% during this window relative to 0.32 for the S&P 500. So a lot of the tech, high beta stuff, it usually does better at this seasonality in June.
I'll comment on this here. So when you look at these bottom two here, XLK and XLY, in comparison with the week previous, so XLY obviously dominated, had a really good week, and XLK was softer. So going into the mid-month seasonality, I would favor XLK over XLY because of that previous performance. And that might be different for people that always think about, past performance like last week is going to continue the next week. But you want to look at, if there is a seasonality event, where's the edge? The edge would be something's been discounted relative to what's expected, not necessarily the other way around. So go through and check these on your own as well, guys, and see what you come up with, okay? This is the June mid-month seasonality for the individual symbols. Now look at Carvana up here at the top, right, Dave?
Yeah.
it already had a pretty big event recently. And also, just again, think about which of these relate to what sectors in the previous slide. So anything pop out at you on this list here?
No, I mean, it looks just like what this previous slide had. ARKK, the Kathy Woodstocks, Teladoc. These are high beta plays.
Yeah. And then some commodity stuff here like Mosaic and US Steel and Schlumberger and stuff on this side. So it does seem to be in line with the ETFs.
Yeah.
Now look at the bottom here. So this universe is pulling from 310 symbols. Not all of them are reflected here, but behind the scenes. And that's based on what these sliders are here, based on the volume and the number of events that are selected in the price. So that's why the 310 are being pulled. But look at that, 62% are positive for this mid-month seasonality window. So it's skewed to a positive expectancy, which means essentially, if you took the 310 symbols and you just went long everything that had a positive expectancy and short everything that had a negative expectancy, by your relative performance should be 0.70 on average. So that's what that's saying to you. Okay. Now, here's a Hughes versus SPY for June. What do we can see from that?
Yeah. Well, if you look at the top right, you see that the Qs are expected to do 1.12 for the entire month, but just within seasonality alone, it's expected to do 1.26. So it's really front-loaded the month in terms of tech performance, and mid-month seasonality is even more than that. So really, this validates what we saw in the previous slide.
Well, and the thing is, this week we have a lot of events, including, because June kind of started on the Thursday there, the first, and the second was the Friday. So the first Friday came right after the first of the month. But this is expiration. So we've got the third Friday of the month coming up here. I mean, there's 5 Fridays in June. Seems weird for a month of 30 days, but there's 5 Fridays. So, and so the expiration is coming upon us here, which it's going to be interesting because it's right at Splunk in the middle of the mid-month seasonality. I find that funny.
Yeah.
So heads up on if you've had good performance coming out of the FOMC, let's be careful of that Friday. That's all I can say. Caution.
I'm looking at the seasonality for Friday, and it's pretty much in theme with mid-month. Again, softer on things like energy, utilities, financials.
Yeah.
So it's still a bit of a risk on theme for that third Friday of the month.
except the indexes themselves, are softer. So it's all about relative performance. So it might be that some of the tech stuff is still doing better, but even though the market's down. So just look at things in terms of relative performance, but a little bit of caution if we're up a lot prior to Friday. That's all I can say. Okay, I wanted to point out the SPY thing here. So you can see that red line up there. That was the August 16th high, and we came up and tagged it. So that was a real pull to that point because we were in a bit of a channel and we finally popped up on Friday and tagged it. So let's look at how exactly did we tag it. We kind of built pre-market, started to push up here. So not a huge move yet, but just starting to push up. And then from the open, we had pretty reasonable climb. It only pulled back to the simple moving average here and stayed above VWAP. We got up to that August 16th high of 431.73. We popped up above it slightly and then pulled back. And if you were looking for a short, let's say, that any one of these lower highs could have been utilized after it came back through. And we often get this. It's kind of like that whack-a-mole game at the arcade, things pop up and then somebody spanks them down. And then we pulled back here and went right back to the previous close, bounced and kind of closed up about a third of the range for the day. So still a positive close, but interesting how we had that reversal. So again, now that we've set that, we've got to again get through it, and then we march on to the next high that you can see, and there's quite a bit of a distance there. Now, Qs obviously have been performing better than the SPY so far this year and have gone through some of their resistance points already earlier, but this was particularly interesting on Friday to have tagged it, gone through it, and then pulled back. Okay, Dave, what about these economic reports this week here?
Yeah. So Tuesday we have some inflation data, core CPI, and then also on Wednesday PPI. So this is about consumer prices and also producer prices to see how inflation is coming down or if it's going back up. But then the key thing this week is Wednesday we have the federal interest rate policy decision at 2 p.m. Eastern, and then Federal Chair Powell also has a press conference. So that's going to be, usually those days are kind of wait and see until the event happens, and then things go back and forth. So Wednesday could be a little muted, or maybe even Tuesday in preparation for that. And then Thursday, we have retail sales, initial jobless claims, and then Friday, consumer sentiment. So I think the key thing is that Wednesday midweek, that could be a market mover if they increase rates or do the pause. So
Right. And remember, a lot of the movement can occur, during the testimony, because people are listening for, the Q&A period. It's like, what are the questions? What are the responses? What's reiterated? So I find, that often can be bigger movement during and after than even at the decision itself, especially if the decision is as expected, which the biggest lean is towards a pause right now.
Yeah.
And then Friday, we have the consumer sentiment, so we'll see how that's changed. But anyway, it's a week full of, we've got the mid-month seasonality. So last week we didn't have really much seasonality to talk about, and we didn't have as many economic reports. So things are, coming into focus here with lots of drivers, lots of catalysts, and should be an interesting week for all of us. There's a couple earnings standouts here. What I posted this, Dave got this together here for me, but I think it's interesting what this says here. So home builders will be in focus this week, but the industry has shown resilience thanks to a low supply of existing homes, with tight inventory offsetting pressure from higher home prices, elevated interest rates, and depleted consumer confidence. So we have some negatives, but the resilience has come from low supply. And also think about, the cost of building now too. So, it's still going to be a while before, the pipeline gets completely saturated with new homes, especially. And I think that it just kind of one of those things that's sort of opposite what people might have thought. They might have thought a massive sell-off because interest rates were rising, but there's always more to the story, and you really have to dig through the weeds and consider a lot of things. So one rule of thumb that I found helpful in my career is to always do what is the consensus and what is the alternative thinking. Mm-hmm. What is the consensus? What are most people thinking about and considering and would act on? But what is the alternative thinking? And find as many arguments for both sides. And that's really a healthy approach. In this case, that low inventory, would have been the alternative thinking to the consensus. Because I know the consensus was largely, the rising interest rates would, and lower consumer confidence, and just the fact that less spending money with inflation would really put the home builders under pressure, and they would make good shorts. And you might have found yourself having trades like that didn't work out, and you go, why? So, and then Adobe here. So we had, we had some move on the AI thing, but it's got earnings, so we'll find out, really what's going on here. That's on Thursday. I like Adobe as a company myself, but use their products and so on. So they seem more credible to add a lot of this AI stuff than some of these newer startups that use the buzzwords. No different than, remember KFC and blockchain.
Yeah.
It's like anybody can add stuff and you can get a big pop on it, but it's these type of credible companies that just like Microsoft with its AI, obviously, or Google with its AI, a lot more credibility there. Okay. Upcoming FOMC meeting, as you know. So this is what's happening in the treasuries. The 2-year advanced 8.7 basis points to 4.6 on Friday, the highest since March 9th. And so for the week, it was up 10.3 basis points. The 10-year gained 3 basis points. The 30-year only added 1. So it's really the short duration that is got the most pressure on it. And so what's kind of happening here is the markets had to deal with this sort of inflation numbers and really good economic numbers that we've had that have sort of increased the concern for longer, elevated rates, that the Fed would probably, they could pause, but they would have to get back to work, and also this week we had Canada and Australia that rose interest rates. Canada did it after a pause, and all of a sudden, boom, a surprise interest rate hike. And so that really rattled these treasury markets. And I think the odds makers with the CME watch tool, it's at 70 or 71.4, I think, percent chance of a pause for June. So that's what the market's thinking for this meeting right now. But that doesn't mean we stay paused. And that's why you see these rates have risen a bit. So keep your eye on the bonds and the yields, okay? All right, I just want to show one other thing here. Find it. Here we go. So what do you see when you look at that map of the market there? What pops out? Boom, what pops really out? Come on, Dave, what pops out?
Tesla.
Up 14.2. This is the weekly, 1 week performance.
Nice.
So that's pretty substantial, right? And actually, we had Tesla in our neutral list for Friday as a short, and I was like, oh, kind of hate the short Tesla, but you know, it's gotten pretty stretched out. And let's just take a look at that. Here, I think I have it here somewhere. So you can see how many days it went on a nice tear here. So this, as far as streaking, this is a pretty good streak. But we had that in January, but this is different now. The move in January was because it was so discounted the year before. And there was a lot of tax loss selling in December, as you can see. And literally the last day of tax loss selling, December the 28th, it actually had a slight up move for the day. So you could see that the selling had dried up. Mm-hmm. The next day popped up on the 29th. No tax loss selling at all. Same thing on the 30th. Coming into the new year, it started to pull back slightly, but then started to build again. And this was rebuying. For the people that sold had to wait 30 days and so on. And then other people caught on that, you know, hey, they're buying the techs, they're buying Tesla, let's get on board. So that's why we had such great performance for Tesla this period of time here. And then it kind of went soft. But what this catalyst is now is quite different than this. This is really related to, you remember we used to say, Dave, that Tesla was more of a battery company than a car company, right?
Yeah.
And so that was really a mental shift to get your head around. It's more of a battery company. But actually, what's happening here is it's becoming more the charging station company. And so very similar to a standard that has to be set in charging, like what happened with your old cassettes or VHS, you know, over beta, or you know, CD formats, or whatever it is, whatever standard of a new technology eventually has to be agreed on, and other ones fall away. So Tesla, by making contracts with Ford and GM, so that Ford and GM can use their charging stations, that's starting to set a significant standard of, you know, the type of plug-in, the type of charging station, and all that kind of stuff. So this is why you're seeing this particular rally. I've been paying attention to that ever since the news was announced with Ford and then GM next. So, okay. That being said, we popped up significantly. Let's bring up the 5-minute chart here. We popped up significantly on Friday, and actually we made money shorting it because it was down from the open. We won't always get that lucky though, right? Yeah, so not one of our favorite things to short, but the StockOdds brought it out to our attention, and it did work. So, but anyway, that's what's going on with Tesla. And back to the map of the market, you can see some of the softer things for the week that were strong the week before. Meta, Google, Microsoft, you know, all that kind of NVIDIA, they were all strong week before. Some of the semiconductors. And then this week, you know, Netflix, because they've dealt with their password sharing thing, and more people are, you know, being forced to subscribe, so the subscribership's going up. So that's Tesla there. But communications, some of the communications like traditional telephone and all that, so they came in. But again, a lot broader than we saw the week before, and a lot more mixed, haves and have-nots, like Merck down, Lilly up kind of thing. It's just very interesting. Energy kind of picked up a little bit for the week, and there can be this separation between the price of oil and what the energy stocks do. So it doesn't always have to be lock in step. You have to look at the stocks for what they are and their potential. Like they have very low PEs, making good money, not necessarily investing in a lot of new drills. So if the worldwide economy holds up and we don't have a big recession, then there's an argument for still more consumption with energy. And we also have the OPEC cuts, right? So the prices could go up, but the way people are looking at this is based on the bottom line for these companies and what they're able to earn. Anyway, one more thing to look at, and that is what's the futures doing. Let's see if FinViz corrected itself yet. Nope. Still showing whacked out here. So just so you know, if we go to the 5-minute here, these indexes aren't showing right on FinViz at the moment. We're slightly up, but not like this. So those are wrong. For whatever reason, I don't know, but they're not right. So go check CNBC or go check, this CME or something for, what the market's actually doing. CNBC is a good resource, and you can see what they are relative to fair value and so on. So I'd look at that. One thing we pointed out on the last week on the VIX was on our podcast, we said it would be heading towards 15, and we got down to a low of 1480. So well done, Dave.
That's amazing.
And unless we get some surprise out of the Fed, I expect it to hang out in this area, maybe even a little bit lower. But and that facilitates. It's kind of a cause and effect, a chicken and egg thing. It's like volatility drops when risk on is on the table, when consumers are buying, when sentiment is okay, and at the same time, when technology actually runs, even if the sentiment wasn't that great, people go, well, why do we need to hedge portfolio risk? We'll just forego that, save some money from the insurance, et cetera. And so the VIX can drop as well. So there's two ways to get a lower VIX, and we're kind of dealing with that now. But keep your eye definitely on the bonds, very important. Keep your eye on the metals as well, and the US dollar. That's going to be instrumental because we're in a Fed week FOMC meeting, so that will affect the dollar. And with that, we will wrap it up. Thank you, Dave.
All right, good luck.